In this video, we're going to look at the triple EMA Forex trading strategy. Stay tuned. Hey traders, a very warm welcome to you. Okay, this trading strategy again, dug it out from the archives of the internet to review it and present it to you guys, and let's see if we can use it to make some more money in our trading. Let me find my mouse. Okay, this is a triple EMA trading strategy. So we have in front of us three exponential moving averages. One is a 10 period, that one's in blue. One is a 25 in red, and the final one 50 period, and that is in lime green. Okay, now the rules of this are, I think they're a little bit complicated when you first listen to them, but ultimately it's not that complicated. But anyway, let me explain. The entry criteria are this: when the 10 period crosses above, so that's the blue line crosses above the 50 period for longs, this is, and we'll flip it for shorts, you are looking for a lower high on the current candle. So we're a 15-minute chart here, and that's the recommended time frame for this setup according to the guy who's coined this setup. So we're now looking for a lower high on the candle. Now the way I kind of interpret that is, we have, you know, one candle here, this candle here, that would be the trigger candle. If we had this scenario, okay, then this one here would be the trigger candle. Does that make sense? So it's the first lower high after you've got the 10 crossing over the 50. It seems complicated, but I think once you get your head around it, we're good. Right, so in this example here, the 10 crosses the 50 around here. I'm calling this one the trigger candle here, because that's the first lower high. Maybe it's that one. Let's do it accurately, I suppose. 112.24. It's exactly the same. So okay, that criteria would use the next candle. So that's a lower high. You then buy 5 or 6 pips above that. Use a buy stop. You've got the filter of the cross of the moving averages. There's the one first thing. Number two, you then have the break above that lower high. So our high would be, what have we got here? 112.23. So we'd have our buy stop at 112.28, something like that. You're in, you're long. And stops, they say you can either have it fixed above but below the low of the candle and then trail it. Now I quite like the idea of trailing, because let's be honest, this strategy is all about, any moving average strategy is about getting on the end of a trend. Okay, if you're buying a moving average crossover, that's what you're looking for. You're looking to get on the end of a trend, looking for that extension move, whatever that may be. So in this example here, you're going long here, your stops here, trail it on a 25 on the 25 period. It makes perfect sense to me. So you're running your stop up behind the price and eventually being stopped out here. So in this example, it's not a bad little move. Initial stop, you know, stop a swing level, you know, decent swing level. Perhaps if you've got a longer, or should I say a larger move in mind for it. If you're thinking you just want to get a little bit of a breakout, a little bit of exhaustion play, then probably you're going to just have a stop below the low of that trigger candle. Now, I have to say I'm not a huge fan of this strategy. For me, it's pretty similar to all the moving average crossover strategies out there, with the added flavor into it of, you know, you've got to have that candle breaking, which makes sense. You know, I have to admit that the sense of, okay, you're not chasing it, you're waiting for that consolidation, and then defining consolidation as, you know, that little lower high and then buying the break above it. That I quite like that to it. But moving averages, to me, if you're in a choppy market, you're going to get stopped all the time. So my thoughts on this are, it's a good strategy, it's okay, but you've got to use it in conjunction with something else. So you're already saying, listen, maybe we're in a range bound environment. You know, maybe you consider we're going to break out already. Maybe we start to break out, you get the moving crossover, you get this candlestick pattern, you buy it. You were going to buy it anyway, but you just add this as a filter. That seems good to me. I think that's fine. To use it as a standalone strategy on a 15-minute chart on every single currency pair isn't going to be profitable. I just don't think you're going to be profitable. Even if you get on the end of some real good gems, you're going to get stopped out so many times with it. You've got to be very picky with it. So anyway, that's a triple EMA strategy, guys. I'm not quite sure where the 25 period comes in terms of the trailing stop. The trigger is the 10 crossing the 50. So there you go. Let me know your thoughts on that below. I know moving average crossover strategies are quite popular. I know that a lot of people use them under the right conditions, and at the end of the day, I'm not disputing the fact if you get on the end of one on a trend and run it for a while, it will more than pay for the losses. But you just got to get on that right trend. So that's the triple EMA, guys. Let me know your thoughts in the comment section below. And as always, good trading. Take care. See you in the next one. Bye bye.